Morning guys, Joel Frank here, market analyst for YouTrading, and this morning we're going to take a quick look at gold prices and what they're doing in the run-up to what is really the most important data point of the week, US August consumer price inflation data. That's out shortly, so let's take a look at the gold chart. I've got it here, spot gold, 4-hour candlesticks, and as you can see, over the last couple of days here, gold has been stuck within a range around 1,780. That's the support area here. And then the 1800, the psychologically important 1800 level, has been acting as resistance on a couple of occasions. And you can see actually yesterday on the 13th of September that the 21 and 50-day moving averages here in orange and green crossed over and that acted as resistance. So yeah, things very much range bound. And this is all because, well, I mean, we are testing lows, but not breaking out below these lows because gold markets are waiting for risk events, and the most important one being, like I said, US consumer price inflation data. Now, markets do expect that to come in slightly below last month. Headline inflation falling to 5.3% from 5.4% last month. I think the core measure of CPI was expected to fall to 4.1% year on year from 4.2% last month. If the data comes in close to expectations, you know, not more than about 0.2, 0.3 away from those expectations, then I think you're probably not going to see too much of a market reaction, to be honest, because when it comes to Fed policy making decisions at the moment, that seems to be being driven more by labor market data than it is by inflation data. I mean, you've had a lot of Fed policymakers already say that, okay, we've already hit our target on inflation, so they're basically ignoring that, and they're just waiting for the progress to be made in the labor market for them to then decide on their QE tapering, and then eventually on rate hikes, although obviously inflation is going to play an important part in that decision. But that's a discussion for 2022. The main discussion for the Fed right now is its QE tapering timeline. And we're still not sure what that's going to look like. If today's inflation is much higher than expected, then that might be seen as increasing pressure on the Fed to basically get on with their QE tapering when they meet next week, because there's a FOMC meeting next week. And, you know, so if the headline inflation came in at 6%, say, that would be really, really high. Well, that would probably cause gold to spike lower. It would break below this 1780 support level. It would probably test this area here in the 1770s, which was support, and then perhaps move on to some of these other support levels a little bit further down. Conversely, if the inflation is much weaker than expected, say the year-on-year rate of headline CPI slips below 5%, that would reinforce the Fed's argument that this spike in inflation is transitory and could be seen as alleviating some of the pressure on the bank to crack on with its QE tapering program. So then in that case, you could potentially see gold spiking towards the top of this recent range, the 1800 level, perhaps going above the 50 and 21 DMAs, and perhaps even pushing on towards recent highs around 1830. So there is risk of volatility. I think if the data is close to expectations, it's probably going to be a bit of a disappointment. But look out for a big surprise either way, and then we could see a big move in gold. So yeah, guys, hope you enjoyed the video, and I'll see you all in the next one.